All right, so this is Chapter 5, Part 2. Right, so this video is going to be all about book tax differences from dividends, okay? And so it's important to remember that when we talk about dividends, corporations pay dividends to shareholders, right? But corporations are also shareholders of other corporations, okay? And so that's the situation that we're talking about. We are talking about dividends received, okay? So let's get rolling. So if it is received from a domestic corporation, then dividends can be included in gross income for tax purposes. Okay, so for tax purposes, dividends are included in gross income. So it's fairly simple. But the issue comes in with how it's treated for book purposes. Okay, so for book purposes, you have to pay attention to the ownership percentage. All right, so if a corporation owns less than 20% of another corporation, the dividend is included in book income, same as tax. All right, so no book tax difference here. So no difference there. But the unrealized gain or loss for the year is included, all right, in book income, all right? So that unrealized gain or loss is not recognized for tax purposes, okay? So this is a temporary difference, and this will reverse when the stock is sold. Now, it's important to understand that the next slide is going to talk about more of these book tax difference rules, okay? I have posted notes for chapter 5 and 6. In those note sheets for chapter 5 and 6, all of these rules are discussed. You do not have to memorize these. You will have access to the notes on your exam, okay? So now, if the ownership is at least 20%, but not more than 50%, the receiving corporation reports its pro rata share of the distributing corporation's income. This is the equity method that you learned about in financial accounting, but the receiving corporation does not include the dividend in book income, okay? So now this equity method is book income, all right, instead of the dividend. So the dividend does not go in book income, all right, and we're going to do an example of this. If the ownership percentage is greater than 50%, consolidated, you do consolidated financial reporting, and the intercompany dividends are eliminated for book purposes. And then if you're greater than or equal to 80%, you do consolidated tax reporting, and intercompany dividends from members of the consolidated group are eliminated for tax purposes. These two situations right here have very complex book to tax differences, and they are beyond our scope, so we will not worry about the book to tax differences for those. All right, it's important to understand what's going on there, but you will not have to calculate the book tax difference for those. Okay, so let's talk about a dividend book tax difference example. All right, so we've got PCC, and they own 30%. of the stock of another corporation. It's a U.S. corporation, and it applies the equity method of accounting for book purposes. All right. So during 2024, BCS distributed a $40,000 dividend. All right. So distributed this $40,000 dividend to PCC. Okay. So this then is going to be included in taxable income. All right. BCS reported $100,000, all right, of net income. So this is the company that is owned for 2024. Based on this information, what is PCC's 2024 book tax difference related to the dividend and its investment in BCS? Okay, we're going to ignore the dividends received deduction. All right, so we know we have a $40,000 dividend that is going to be taxable income to PCC. Okay, also, all right, so that's taxable income. All right, what is the book income effect? To PCC, all right? So the book income effect, we know that they own 30%. And we know that BCS earned $100,000. So the equity method says $30,000 is book income to PCC. Okay, so let's take a look at what we've got going on here. So we've got $40,000 of taxable income and $30,000 of book income. All right, so what then is our book tax difference? All right, well, it's the difference between taxable income and book income. All right, so our book tax difference is $10,000. All right, and is it favorable or unfavorable? Well, look, our taxable income is larger than our book income, so it's unfavorable. This unfavorable difference, is temporary, since we have not talked about the dividends received deduction. Any difference resulting from the dividends received deduction is going to be a permanent difference. Differences related to the equity method, will be temporary, because they will reverse when the asset is sold. Now, for this one, again, the the options got lopped off, but that's okay. When you're looking at this one, I would look at those notes pages while you're looking at this one, and that the notes for chapter 5 and chapter 6 that I posted on Canvas, and that will help you as you're reading through this one. So what this one says is Corporation A receives a dividend from Corporation B. Corporation A includes the dividend in its gross income for tax and financial purposes. So no book tax difference, all right? Corporation A also reported the unrealized appreciation in the stock in its books, but not taxable income, okay? Because it's holding Corporation B stock as a trading security. So if A has accounted for the dividend correctly following the general rule, how much of B stock does A own? Okay? And so the answer is going to be that A owns less than 20% of the stock of B. All right, and this is right out of the definitions of how to account for dividends. Okay.